Welcome to the Bordeaux Blend, where we're blending expert opinions and ideas to help people improve their everyday financial decisions. Today, we're talking about investing in sports and not this time media rights, but sports teams themselves. I think this is a very interesting asset class with a lot of asymmetry and uncorrelation to the areas that people are traditionally investing in. There's a lot more interest now in institutional investors in particular. And today, to help us with that conversation, is Christopher Zook, who's the chairman and CIO at CAZ Investments. He's got more than 30 years of experience investing in both traditional and alternative asset classes. I think they are of particular interest, just given their leadership within this space and the ability to access other areas within the sports team and franchise investing that others cannot. So, a particularly good person to have this discussion with. So please join us, and I hope you enjoy the conversation today with Christopher Zook. Christopher, thank you very much for joining us today.
I'm happy to be here. Thank you for having me.
First of all, just to give listeners a little bit of background on yourself and the company, where your focus is, can you give us a quick, high-level introduction of both yourself and a lay of the land as to where you're looking at investing these days?
Certainly. So started the firm 24 years ago, and we are a thematic investor who will invest in anything, anywhere, and any time based on very significant themes that we believe are going to persist over significant periods of time. And we will go wherever that may take us, whether it be the public markets, the private markets, et cetera. And so as we think about the world, we try to identify where those tailwinds are going to be. We're going to try to find the best risk reward way to take advantage of those tailwinds, and then ultimately find the best partners in that area that have the domain expertise to be able to bring to bear, whether that be in-house or partnering with external folks to do the same.
Great. I think that's why we like you guys so much, is we have a lot of similarities there. And I think that's one of the big themes that we're always looking for is asymmetry. And how do we get that across portfolio assets, and sports in particular being a very interesting theme where, you of course are doing quite a bit more work there these days that seems to be compelling for investors, something that a lot of people are looking at. But can you give us a broad overview of that asset class in particular, and under the umbrella of sports? Where is your focus? And maybe just as importantly, where is your focus not?
It's so funny because I actually don't watch professional sports. I'm not actually a sports fan. Our primary partner in the space, he is not a sports fan. And we're not involved in sports for the sake of sports, even though everybody says you're just in it because it's interesting and it's fun and it's exciting. And it is interesting and it is fun and it is exciting, but that's not why we're invested there. The theme is definitively the change in consumer behavior. And when you look at the consumer, there's some irrefutable trends, but one of which is cord cutting. And cord cutting is undeniably going to continue to be a thing. It's not going to reverse and everybody go back to cable and broadcast. So what happens is that advertisers are really stuck. And because they're stuck, they cannot reach their audience. They can micro-target with social media. But then if they want to reach a broad cross-section of audience, they can't do that on any of the streaming services. So, Amazon, Netflix, et cetera. So what happens is they have to go to live events where people will watch the commercials because they don't have a choice, i.e. the Super Bowl, to use your statement there. And so when you have 120 million people all watching the exact same show at the exact same time, your advertising dollars obviously go a lot further. So when you combine that with the fact that 90+% of the top most watched live events are sports, you really want to find a way to invest in that. The good news is 4 years ago, the major North American sports leagues, Major League Baseball, soccer, hockey, and Major League Basketball, National Basketball Association, they changed the rules to allow private equity and institutional investment into multiple franchises if you can meet a lot of very specific tests. The NFL is the only one that is not yet approved, but we think that's going to happen. It's most likely a when. It's not an if. It's just a matter of the timing of that. But so when you combine all that together, you end up with what you talked about, a very low correlation, resilient positively asymmetric opportunity that has a business model that's really very different than most people fully appreciate.
Yeah, and I think what's difficult for a lot of people who are more traditional investors is just understanding how this shapes up against some of the asset classes that they are used to. One of the key things, obviously, people want to understand the downside. What's the risk? How do you think about and measure risk in something like this, seeing as it's not something like a stock that's marked to market basically immediately during market hours? How do you size that up and manage it appropriately?
Yeah, our firm adage has stood the test of time, which is if we could live with the worst case scenario, the upside will take care of itself. And I was the skeptic more than anybody else in the entire organization for 18 months before we made the first investment in sports, because the first dollar in everything we do is mine. And so as a result, if it's not good enough for me, then we're not going to show it to you or to your clients. So I was literally the holdout. And it was because of exactly that question, as I really wanted to understand the downside. What I learned through that process is that this is very different than most other investments in that it is a legal monopoly. We always know that it's a great idea to invest in something that cannot have competition in a local market. Literally, the Golden State Warriors, there is no other basketball team in the NBA that can compete in that local market. Same would be in the Sacramento Kings, etc. So what you have is you have a monopoly. That's the first thing that gives you downside protection. The second thing is this enormously contractual revenue stream that I certainly didn't appreciate before I got involved in the diligence. And that is when you own Golden State Warriors, you own 1/30th of the business that is the NBA. Whether you are the last place team or, as Golden State's been many times, the first place team, it doesn't matter. You still get your 1/30th of the entire revenue of or profitability of that league, and it's a dividend that you receive every year. So that's very, very profitable, and most of that revenue comes from national media rights, which are obviously locked up. So whether you're Apple and you just bought rights to Major League Soccer, or you just are Amazon and you bought the rights to Thursday Night Football, you are going to have a contract. You don't get to choose whether or not you want to pay that contract or not. Just the same, the stadium rights in your local market, here in Houston, it's the Minute Maid Field, which is the home of the Houston Astros. Minute Maid didn't get to choose whether or not they paid that bill or didn't pay that bill. They had to pay it regardless of what was happening inside the stadium or outside of the stadium every single year, as well as the other local sponsorships, the local media rights, and then the season tickets. Something that really is not fully appreciated. The word fans comes from the word fanatics. And so we have these things called fanatics that they will let a lot of things go before they will give up their season tickets. In some cases, 90% of the actual game day revenue comes from season ticket sales before the game ever was even held. So that predictability and that consistency leads you to significant downside protection. And then another thing is that most people get in trouble with investments or have very significant losses because of excess leverage. In the case of the North American sports leagues, they are not allowed to do leverage by rule more than a certain amount of their balance sheet. So some leagues it's 20%, some leagues it's 15%, but it's very, very low. So if you don't have a lot of leverage and you have a very sticky fan base of fanatics and you have very significant contractual revenues that don't matter what's happening in the economy or what's happening on the field or the pitch, you have a very, very predictable business, which is why if you look back over all of the recessions that we've had in the last 30 years, the four North Americans, main sports America, the four major leagues in North America, if I can spit that out, they have literally never had a decline of revenue year over year. This COVID, they obviously did in the on-field, but when you take back the exception of that, there's never been another time where you've had zero losses of revenue, negative year-over-year comps. They've not grown as fast some years, recession, global financial crisis, etc., but they still grew. Compare that to a lot of other things that all of us invest in that have very significant sensitivity to the economic cycle. So you combine all that together, and professional sports becomes one of the most consistent value creation, but also protections which is why it has such a low correlation to the S&P. A lot of people don't realize this. The correlation of professional sports is literally less than 0.1 to the S&P 500. So great correlation, very, very, very significant downside protection.
We like those sticky customers. I have a best friend of mine, his aunt and uncle, who are from Massachusetts, sold their only car to get New England Patriots Super Bowl tickets one year. I will never forget that because I was just shocked beyond belief. But as you mentioned, great from an investment standpoint. How do you think about, and can you help some of our listeners quantify whether that investment should come back as cash flow or dividends, maybe, as you mentioned, versus appreciation of assets? And on the appreciation side, are you looking at some point to then exit that position like a traditional private equity firm would and distribute that back to investors?
So I'll answer the second part first because I think it's informative to the first part. So yes, the exit for these investments typically is going to be very much like a traditional private asset, where you own it until you don't, you sell it, and you exit stage left. That is very, very common. In the 70s and 80s and 90s, and there's certainly some clubs today and some franchises that have been held by one family for a very long period of time, that's not who we're going to partner with. We're going to partner with very professional run organizations where they plan on growing their business and then having some form of an exit that could be in the form of an IPO. It's been well documented. The Golden State Warriors, as an example, they plan on going into an IPO and doing an IPO. It could be in the form of a sale of the entire business or various pieces of the businesses. So it is something people can expect. In our particular case, we actually have created an annual secondary process where after someone's been in a vehicle for a period of time, they can actually sell their position. So we're a little bit different in that regard. But when you look at the asset class itself, you're talking about the ability to own an asset that hopefully appreciates over time. You have an exit, you have long-term capital gains treatment on that sale. There are some cash flows that investors can receive over time, but we would tell people to plan on looking at capital gains, which is the long-term attractive nature of it to compound wealth without having to have big tax burdens on the way. That obviously is what we would manage expectations towards. The other thing that is also a little bit unusual is that for taxable investors, and obviously everybody talk to your own tax advisor, but for taxable investors, there are some pass-through depreciation amortization that can actually generate pretty significant tax savings depending on somebody's personal situation. So there are some tax benefits, but it's not something to where somebody should expect a coupon of I'm going to make X% a year of cash flow and then sell it. There's a lot of other type of investments we do that fit that criteria. This is not one of them. This is I'm going to invest $1 million. I expect to sell it at some point at $2 million, $3 million, $4 million in the future. And one of the things that's a fascinating statistic is when you look back over the last, I believe it's 35 years, the average return of professional sports in North America has been over 18% compared to the S&P 500 over the exact same period at closer to 11% and bonds at closer to the 5 and change percent return. So very significant long-term appreciation of these assets, tax deferral until you actually sell them with some tax benefits as you go along, depending on the circumstance and obviously one's personal situation.
Can we zoom in quickly on the tax benefit side? And not, again, that this is advice necessarily, but I did not know that. And I think people often think of municipal bonds or real estate, and maybe real estate is a component of this given the stadiums. But what are the actual underlying mechanisms by which that tax benefit happens? And how much impact, roughly, not exactly, does that have on the longer term returns?
So it comes from a lot of different sources, and it does depend on the particular club, the platform that they have. You used examples of different clubs. Some of them own their stadiums. And so if you acquire alongside a control investor or you buy into a situation where there is depreciation from the ownership of that real estate, that's going to pass through the same way as any multifamily or a commercial building would. very, very similar. You're also going to have certain benefits where you get amortization and or goodwill that you're able to, depending on the type of transaction that occurs, you can get some of those benefits that pass through the K1 to the underlying investor. And depending on somebody's state tax situation, that can be a much higher benefit than if somebody is in a zero tax environment. Obviously, it really does depend on what type of income someone has, which is why they do need to consult with their tax advisor. But what we tell someone is the average, and again, average is always a dangerous thing. But if you look at the average taxpayer, high net worth, high income taxpayer, it can be 3 to 6% of current cash yield every year just from the tax savings. Now, don't let the tax tail wag the dog. Don't make the investment for that reason, but it is a nice benefit that helps increase the internal rate of return because you're getting some current benefit while you wait for the long-term appreciation of the asset.
Yeah, that's fantastic. Coming back again a little bit, this is in the realm of risk, but I think one of the things that I was listening to Ian Charles not too long ago, and he was talking a little bit about defensibility and moat, and you have the ability to participate across categories, maybe where others cannot. Can you speak to people a little bit about that? Why do you get that benefit? Why do others not have that same benefit? And how does that persist?
One of the things that's really unique about the structure of professional sports in North America is that you are not allowed to buy something just because you have money. You must not just be a financial buyer. You have to meet a lot of other criteria. Those criteria in some cases are pretty obvious. You can't be an umpire, as an example. Not necessarily that you're going to be able to write the check to buy one of these franchises, but you can't have those kinds of conflicts. It's pretty obvious that would be bad. The same would be true if you own or your firm, whether you be one of the largest private equity firms in the world, where you have lots of their senior executives, they own stakes in a variety of firms. We own a minority stake in Platinum Equity, as an example, and based in Los Angeles. Platinum Equity cannot ever do a sports franchise in the National Basketball Association because Tom Gores individually owns the Detroit Pistons. So therefore, he cannot, even if he wanted to, be able to go and invest in any other teams in the NBA because there's obvious conflicts there. So when you strip all that out, you end up with a very small number of people that can actually own these franchises, and only a few, Arctos in particular, have the ability to own multiple teams in the same league, where Arctos is certainly, and that's who Ian Charles, he was co-founder of Arctos. Arctos is unusual and our partner there because of the fact that they are the only firm that has the ability and is pre-approved to acquire multiple teams in multiple leagues. So we own many businesses in baseball and in basketball and in hockey and in soccer. We also own things internationally like Paris Saint-Germain and Aston Martin in Formula One. So we have this very broad, diverse amount of assets, which creates the moat because we can't have a lot of people compete with us, but also the diversification, which creates that asymmetry that you talked about across so many of the different leagues who all have different characteristics, have different correlations, and that obviously enables us to have a much more diverse portfolio.
Right. And I think that's attractive for most people where they're not going to be operators. They don't necessarily understand the business there. They want to spread the risk as much as they possibly can. I think that's certainly beneficial. One of the other things that jumped out at me in going through a little bit of the presentation and the numbers behind this is that in deconstructing where the performance is derived from, I was a little surprised to see that asset selection was maybe a 3 to 4%, correct me if I'm wrong here, attribution. I would think that's higher. Why is that not the case?
So what I'll tell you is when you look at these businesses, and we'll use a kind of a wonky term of beta versus alpha, when you look at the returns of the businesses, they do have a beta to them. And part of that is because of what I talked about earlier, which is you own 1/30th of the NBA. If the NBA throws off, and I'm not saying these are the exact numbers, but let's just say for round numbers, for discussion purposes, if the NBA, every single franchise is going to get $350 million this year. Well, obviously, the value of all franchises is going to be at a certain level. So then your ability to generate alpha, which is outperformance of that beta, is going to come from really one of three areas. Number one, selection of the businesses that are being run the best and have the most opportunity going forward. The second is going to be the diversification across multiple different platform investments. So, like as an example, one of our firms, they own the Pittsburgh Penguins, the Boston Red Sox. They also own a piece of Liverpool. So you have this just bought into the PGA Tour. So we end up with a lot more diversification. So you're going to get alpha from that diversification that's not just tied to one specific league. And then the third, and what is many times the most important point of alpha, is the structuring of these investments. Like in some cases, several cases, we have a 1% liquidation preference to where we cannot lose money even if certain things happen really badly, go very badly. That gives us a lot of protection that can also create some alpha from ratchets and other things that are tied to the overall performance of the investment that the team at Arctos does a fantastic job of representing us on, to be able to get us into the best clubs, the best franchises, in the best way, in the best form, and then also to be able to use data science to accelerate the performance of those clubs as well. But so you're always going to have some beta in any kind of an investment. And the key is where's the alpha come from? And one of the things that Arctos has proven to be very, very good at is identifying that alpha and obviously delivering on it.
I want to quickly touch on, again, just coming back to some of the basics and fundamentals here, portfolio construction. How many investments are actually taking place? You mentioned a few different leagues there just a minute ago. You also mentioned that the NFL at the outset of the conversation doesn't really participate yet, but what are the different areas that you're pulling from, or at least sourcing some of these deals from, and how does that actually translate into portfolio execution and implementation?
Portfolio construction is very similar to what you would do with a typical private equity fund, in that you're going to have 10 to 15 different companies. Some of them are going to be more single assets. Some of them are going to be platforms that are going to end up with some bolt-on acquisitions or expansion as part of that. I'll use the Fenway Sports Group again as an example. There you've got a platform where they've got teams across multiple leagues, as well as, they own Fenway Park, and, you have significant real estate assets around the stadium. Those are the kinds of assets that certainly are going to be a one investment, if you will, but actually have a lot of diversification around it. And then in other cases, it's going to be, the Warriors, it's just the Warriors, and you own that single asset. So naturally, the more diverse the platform is, the larger that position typically is going to be. The less diverse that asset is, the smaller that position size is going to be. But so much of that will also be driven by structure. Certainly you wouldn't expect it to be, round numbers, 7% positions. It won't be that. It will obviously have some bigger and some smaller. Some of that is just based on what's available to purchase. And some of that also is going to be tied to what type of structuring is built into that. The more structuring, the larger the position size, because in virtually every case, it means you have a lot more downside protection, and you can proceed to accept a higher position size concentration because of those protections that you have in there. But you also look at it from the standpoint of different types of assets, in that you're not going to have the entire fund or any particular vehicle be just one sports league. It's going to be diversified across the North American sports leagues with 70 to 80% of the assets is what's expected. And then there will be some international assets. And then there'll be some other, ancillary assets that feed off of it. As an example, it could be technology that is around ticketing, or it could be, sports performance type investments that they own that tie in to benefit from the digitization of what's happening in sports. I mean, it's not going to be long before you kind of can already do this, but you could sit at home on your phone, just decide, okay, I want to watch this play, this pitch from behind home plate. I want to watch it, the next pitch from center field. I want to watch this one from right above the pitcher. You're going to be able to do all of that, of course, for a small fee. You're going to be able to have that customization. And when you look at that fan experience and the way that's being improved, all of that increases engagement, which brings more people to watch it, which means obviously more advertisers want to reach that audience. that is ultimately the flywheel that is driving professional sports right now.
Maybe now you'll be virtually sitting at the stadium with your Apple goggles on with the rest of the crowd. You mentioned structure earlier. Can we talk a little bit about just market and investor structure? Because I think traditionally, keep me honest here, I think this was mostly ultra high net worth folks. Usually they're investing at a minimum, or they need to have $500 million or $1 billion to invest in the space. That's changing now with some more institutional capital coming to market. How is that changing right now, and what do you expect that to look like over the next few years?
Well, the advantage that we have is we're very much early in this process, and we have, with our partners, with Arctos and others, we have a kind of a first mover advantage. That won't always be the case, but the rules that the leagues apply means that you're not going to have just this mass quantity of new buyers come into the marketplace. And one of the things that's really interesting is it always historically has been what you described, which is it's been a billionaire's game. And only billionaires had the ability to buy into a sports franchise unless they happen to know an owner and the owner would let them come in at 5, 10, 15, $20 million as a small piece of what they were doing. And you had just a personal friendship or relationship or business relationship. That is now definitely changing to where institutional investors like us have the ability to enable all of our ecosystem to be able to invest alongside of us in these assets. And the key is the same rules apply. If someone is conflicted out, they cannot invest alongside us or anyone else for that matter, because of the fact that they have to meet the league's test, and everyone has to go through that same filter, if you will. But for the first time, people can invest $250,000, $500,000, $1 million and own a piece of some of the most iconic sports brands in all of the world.
Yeah. Do you think that that regulatory, or at least the commission oversight for each of these various leagues, will change their attitude a little bit to the criteria that's needed to invest here? Or do you think that's likely to stay the same, at least from that standpoint? Because that seems to be the big hurdle and the benefit of working with an institutional investment group that is already here and is early in the process, is they've already overcome those hurdles. That's not necessarily a risk anymore that you need to worry about. You can piggyback on that. But do you think that might change as more participants come to the space?
I think there will be an opening up over time to have others be able to come into the space. There's mixed feelings there. You don't want to have to compete with people, but at the same time, it's nice to have people in the space who want to buy assets from us. So, if someone large sovereign XYZ is able to get approved and they want to acquire a bunch of assets, we might just have something we'll sell to them. If they're not allowed to participate, then obviously we don't have to worry about competing with them on price. And ultimately, it allows us to have a really great opportunity to buy quality assets at very reasonable prices and partner with those management teams to be able to make them worth a heck of a lot more. I will tell you, the leagues, they're so focused on reputational risk, and they're so focused on making sure that no one can accuse them of anything being less than the true spirit of competition. And so when you think about some of the high profile sellers that have been forced to sell, not going to name names here, but there's several people that had to exit their position. They were not given a choice. The league came in and said, because of either behavior or comments or public comments, etc., they literally were said, you need to go. And so that, of course, gives opportunity for us to be a buyer of those assets, which in some cases we were. In some cases, we also just tagged along and, were sellers, with folks that had to sell their businesses, in the case of entire businesses. But ultimately, the ability for us to be able to be true partners with the management teams and know that the leagues are going to protect who is able to be involved in that with, it is a major, major issue for someone to go through from background checks and a analysis of their reputational risk to the leagues. They take it very seriously because it only takes one bad apple to really spoil the bunch. So they really don't want to have those bad apples in the mix. That's why I would say that if they do it, it's going to be slowly. If they allow others to come in, it's going to be slowly. I certainly am looking forward to having some of those people come in over time because we would be more than happy at the right price to actually sell and exit our positions.
Sure. And I'm sure they like also some of the added benefits that come along with your participation in that space. I know in particular, Arctos's platform, they have some post-acquisition operational benefits that can be of broad value to the companies, the leagues and franchises that they're participating in. Can you give people just a quick sense of what that looks like? Because I think it's extremely important. I think it will just compound over time and help with a little bit of the staying power as the leader in this particular investment category.
Agreed completely. And it really comes in two forms. Number one would be kind of traditional private equity assistance to be able to come on with a fresh view and say, okay, we're on the board. Have we thought about acquiring, use Sacramento as an example, Sacramento Kings, take a position? Have we thought about taking a position in the minor league baseball team there in Sacramento? Never thought about it. Why don't we consider that? As a matter of fact, we'll help you structure it. We'll help you negotiate it. We'll help you figure out the right way to, make it a win-win for everybody. But then when you do that, you now control the vast majority of all of the live event venue activity, including concerts and big events right there in Sacramento. You basically cannot go anywhere unless you go through that organization. Also allows you to consolidate ticketing, consolidate advertising, consolidate marketing, all of those other things that allows you to be more efficient and more effective with. The second side, and that's what Arctos absolutely brings that to the equation, the blocking and tackling of helping with M&A and strategy. The second is data science. And Arctos has spent a tremendous amount of money being very, very good in data science. And I've heard directly from owners of professional teams that really didn't need to sell a stake in their business, but they saw it as a strategically valuable thing to do because of the fact that Arctos was able to tell them more about their fan base, more about their engagement levels, more about how to reach them than they knew with their existing teams. So they could either go build out that data science department over however long and how expensive that may be, or do a very logical strategic investment from Arctos into that club and get all of that for free. The second thing that they can do, and Arctos has to be very careful with this in the data science world, is they know everything that's going on in all of the clubs that we own stakes in, not just one. So if you own one baseball team, you know what's happening with one baseball team. And yeah, you might get a little of information from your friendly competitors, but you're not going to probably get all the details. So Arctos obviously can't say who specifically does what, because that would be a violation of confidence, but they can say, okay, the average for all of our teams is, I'm making this number up, 14%, recurring revenue from this particular source. In your particular case, owner, you're at 6%. Well, there's a really big opportunity to get you up to what the mean is. So let's figure out how we can invest wisely to accomplish that. Those things are very difficult for an owner to do for themselves, but they can get that when they partner with Arctos and obviously with us as a capital provider there and a partner with them. It's really where you truly find 1 + 1 can equal a lot more than 2.
So is there, to facilitate that, kind of an internal team that might serve various functions for go-to-market or other areas? How does that actually come into play relative to just working with the resources that the team or the league might have, whatever asset it is that you're acquiring?
So Arctos, I'm going to speak to their team specifically. Arctos's team is built up of a bunch of finance people and a bunch of sports people. You put them together to make a very unusual franchise that is built specifically for one purpose, and that is for sports. Along with that, they also have a very, very high quality group of operating partners from media, from sports, from finance, from all different areas. So as an example, for anybody who's a baseball fan, Theo Epstein is an operating partner of the Arctos team. So for those that don't know Theo Epstein, he was the one who brought the World Series to Chicago, and he also is the one who brought the World Series as general manager for the Red Sox. So he is a somewhat of a legend as a relatively young person in the world of baseball. He is dedicated to Arctos as an operating partner. So that kind of talent they can bring to bear across whatever asset is looking to improve in a particular area And maybe it's Theo Epstein in one area of baseball. It could be somebody, when you start talking about negotiating national media rights, they can bring that value to the league. If it could be somebody negotiating their local media rights, that obviously can be brought to bear. It's very similar to the way that most private equity firms operate. But what has never been done before is that been brought to bear for professional sports, because people were not allowed to until 2019 to bring those resources to the table, because private equity ownership was not allowed until 2019.
What changed specifically in 2019? Was it just a single law that then allowed new entrants to come into the market at that point in time, or was there other aspects and dynamics that changed along with that primary result?
So it definitely was the stroke of the pen. It was a rule change that was voted on first in Major League Baseball, and then soon after from the NHL, the NBA, Major League Soccer. What drove that was, as much anything else, trying to make sure that the clubs themselves had the best opportunity to be successful. But ultimately also, if you're an owner of one of these franchises, if you ever plan on selling, do you want a small amount of capital able to buy, or do you want a larger pool of capital available to buy? That obviously helps you increase your value. But when you think about these teams in particular, rumors abound about what the value of the Warriors, is today, but it's probably in the $5 to $6 billion range based on numbers that I've seen. And you start saying, how many different people out there can spend $5 to $6 billion? We saw obviously what happened in Denver with the Broncos and the Walton family. We saw what, one of our partners, Josh Harris, and David Blitzer, we're very significant partners in their Harris Blitzer Sports, Philadelphia 76ers, the New Jersey Devils, the Prudential Center, and some other assets as well. But now, obviously, Josh and other partners bought into the Washington Commanders in the National Football League. But there's literally like 10 or 12 people on the planet that can write the check size big enough. Well, obviously, that creates a problem for anyone that's looking to monetize. And it actually is just a real problem for liquidity in the overall league. But most importantly, and I do think it's most importantly, is the recognition that the right institutional partner can make everybody better, which increases the value of the league, which increases everybody's pro rata share. And that is really the most interesting thing about sports. If we just say, okay, find what matters. You have a governing body that chooses to have legal monopolies, and their sole goal in life is to increase the value of all the franchises. So in every other business in the world, the regulators usually are not focused on how to make you more money. In the case of sports, that's exactly the regulators who control that. They want to increase the value of everybody's investment. That obviously is good for the players. It's good for the citizens of the community. It's good, obviously, for the owners of the businesses as well.
And I want to come back quickly to, you've mentioned a couple of different leagues here as well. Obviously, things like Formula One are going to be vastly different than the MLB. What are the areas that I suppose you're most excited about, and where are you focusing your intention and resources right now, kind of across that stack? I guess easier way to say it, where's the emphasis in particular leagues, and where's the least maybe but growing?
So 28 to 54 are numbers that everybody in advertising knows, because that is the sweet spot for advertisers. 28-year-old to 54-year-olds are your largest consumer base, particularly for consumer goods. And if you look at that, males are more the spender on average, obviously being stereotypical here. But so if you want to reach 28 to 54-year-old males, then you're going to do that with sports. So if that's the case, the tailwind that we recognize is that we're likely to want to be involved in sports that are attractive to that demographic. If that is the case, it's going to take you to the NBA, to obviously, when we're allowed to, the National Football League, to Major League Baseball, to Major League Soccer, to European football, to Formula One. There are others as well, but those are certainly the biggest. So when you ask the question specifically where we are today, it's really driven by valuations. So one of the things that people assume is that you have to pay whatever you have to pay to get into a team. That's just not true. There is a relatively efficient market. And when we're buying in as a minority owner, not in a controlled transaction, you're going to get a minority discount because you don't have control of the asset. So you should pay less. And so there are times where various leagues are going to get maybe a little bit too expensive, or maybe they get less expensive. We're going to be opportunistic to where the best prices are, but with constant evaluation of where the growth is going related to that 28 to 54-year-old demographic. In the case today, there's a lot of growth in Major League Soccer, but it's also less proven. It's not been around as long. It's not been as durable. You certainly don't have the same valuations. But with some of the major names that have come into United States Major League Soccer, it's a growing area. That's the reason why Apple spent so much money to buy the rights to it. Is they're, to borrow the hockey phrase, they're going where the puck is, skating where the puck is going. So we do like that area, but if we can buy an NBA franchise with all of its international growth, with all of its significant appeal to the target demographic, it's really attractive for us. And what's interesting is the businesses all throughout are becoming that much more persistent from a profitability standpoint, which is a big misnomer. Most people think you just lose money, and sell to somebody who just wants to pay you a higher price for it. It's just not true. 90% plus of the more North American sports franchises make money. And over, I believe it is 60% of them run 20% EBITDA margins or higher. So that's not our grandparents' professional sports team. That is the current 2024 version of professional sports. We do like what's happening in Europe in particular areas. It's a different dynamic because of the fact that you've got a different ownership type structure. And you obviously have relegation and other things that you have to be thinking about when you start talking about, football in Europe. But you think about Formula One, it's not just a Netflix special phenomenon. This has been a very profitable business for a long period of time, an enormously profitable demographic to target. And so there's really significant professionalism there. NASCAR is an area that I think also has a lot of opportunity. It's broadening its fan base. It's broadening its appeal. And so as a result, it's reaching a much bigger audience. And then we're going to continue to look at assets there. Joe Gibbs Racing and a couple of other assets, would be examples of that.
So valuation aside, are there any areas that you're a little bit wary of at the moment, or you're approaching with a little bit more caution?
If you're going to do European football, you must be very diversified because of relegation. Paris Saint-Germain is maybe an exception to that. Liverpool is maybe an exception to that, but you still got to be mindful of it. And so you have to be also very skeptical of highly levered transactions in Europe because the risk reward, the asymmetry is a little bit harder to find. So we're doesn't mean we won't do it, but the hurdle is much, much higher. Therefore, the valuation needs to be lower in order to compensate for that risk. But we really are focused more on the North American sports leagues. Hockey is one that kind of people have forgotten about, but there's been significant improvements in the operational efficiency, the fan engagement level in hockey, and there's definitely some really good media things going on in that league. Therefore, it's very attractive. Tampa Bay Lightning is kind of a juggernaut in that regard, a good example of where you have somebody who's a professional investor who bought the controlling stake. He's a really good business person. He knows how to engage with the fans, how to look around the stadium to be able to make good strategic investments and ultimately build a platform that can be much more than just, a single hockey team. So we like those kinds of situations. We will be very skeptical of investing in a team where it's really is just someone who just wants to own it and give it to their children and their children's children. That's not really a good fit for us. That doesn't mean it's not a good investment for them, but it means we need to be aligned that this is about growth. This is about really increasing the fan experience, being pillars in the community and giving back to the community. And at the same time, just really engaging the audience, which ultimately drives media and sponsorship and profitability.
I know you've mentioned a couple of teams here and we're getting close to our time, but I suppose just to round things out, without divulging anything you're not allowed to divulge, could you give us maybe just a couple minutes on a case study of a noteworthy investment?
So probably the easiest in very generic terms is there's a basketball team that's close to you that we were able to acquire from a forced seller, that we were able to buy in at a 25 to 35% discount to really what we think intrinsic value is. Now, in that particular case, it was a secondary transaction, but we also participated with that particular club that it was growth. It was about what can you do with new stadiums? What could you do with real estate around the stadiums? How could you potentially increase the diversification of the platform into other leagues? And also do that in a way that is aligned. We have a phrase as a firm, we're freakish about alignment. If all else fails, people usually will make better decisions when they're aligned together. And so in that particular case, you've got an ownership group that is aligned across not just us with them, but also the other owners. They have a very common vision, a common goal, a common objective, and that is to ultimately take this business and make it one of the most valuable franchises, if not the most valuable franchise on the planet, by making good business decisions and making good investments in the future to leverage what is already an iconic brand and make it even better.
Well, great. Christopher, this has been wonderful. We thank you very much for your time here today. I think it's fascinating. I'm looking forward to watching your continued success. And I think having a little bit of skin in the game always makes things a little bit more interesting if you're actually watching sports. But thank you again for your time.
Absolutely. Thank you for having me.